everyone, welcome back to Monetary Research LLC. Today we're going to be going over AITX, Artificial Intelligence Technology Solutions Incorporated. It's a pretty long name. But first of all, I want to start off by going over what this company does. Just a quick summary from Yahoo Finance here. Artificial Intelligence Technology Solutions Incorporated focuses on the delivery of artificial intelligence and robotic solutions for operational security and monitoring needs. It also develops front-end and back-end software solutions. The company was formerly known as On the Move Systems Corporation and changed its name to Artificial Intelligence Technology Solutions Incorporated in August 2018. Artificial Intelligence Technology Solutions Incorporated was founded in 2016 and is based in Ferndale, Michigan. That's just a little summary about the company itself. There's a manifesto, basically their mission statement on what they want to accomplish in their website. Here's a CEO, Steve Reinhardt. His name, I'm not sure if I'm pronouncing that correctly. Here's Romeo. This is one of their main products. This was recently at the World Series. That they had it out there, and I think it did boost the stock a little bit. Great product. This is another famous one. It has cameras, microphones. It speaks out loud. All that good. You can check that stuff out. I'm here to mainly go over the stock. But that's a little bit about their main products. It's the Romeo and the I believe this one's called the Rosa. I'm not exactly sure what they're called. They have a ton of them. They have other products as well. But let's see if I can find a picture really quick of the other. No, you can just look up the company. I'm here to look over the income statement and the stock. The income statement and the stock mainly. So here's the stock. This has been trading. I know it's a disaster, but this is more of a long-term hold. I believe this company will do good within the next 5 to 10 years. The thing about this company is that it is very diluted. It's about approximately 4.9 billion shares. So it's a very diluted stock, and I believe it is going to be even more diluted as they grow. This company is still traded over the counter. It's not traded on the NASDAQ or NYSE or anything like that. So this company is still growing, and I believe it's still going to be even more diluted in terms of the stock. So I recommend, if you want to really get in, if you do even more research, just go ahead and do a long-term position and just do dollar cost average as you go. I'm just here to go over the income statement and a little bit about the company. I'm not here to go into depth about their products and all that stuff. I'm just here to summarize and explain a little bit about the stock and what I see going forward. So as you can see here, they don't pay a dividend. This is just horrible stuff because the company is still in the growth process. Nobody really knows about it, which is good, because you don't want people to know about your investment that you're making. As you want it to be cheap. You want it to be more supply than the demand for the stock, at the time of getting into the investment. So with that said, let's go ahead and look at the the balance sheet. Not the income statement, the balance sheet. To me, that's a little bit more important, how their money is working for them and where it's allocated and all that stuff. I'm sure you know what an income statement is by now if you're looking into over-the-counter stocks. You should know how to analyze it and how to analyze a balance sheet and an income statement. But today we're going over the balance sheet. To To start off, cash in short-term investments, which is very liquid assets, in other words, cash, and stuff that can be turned into cash within a year. I believe it's a year, and I'm pretty sure I am correct. But as you can see here, in 2017, 56,000, okay, in cash, and now presently 2021, 1.04 million, okay. Now that right there is what growth, what growth is like. 7,748.64% growth just in cash, okay. That's incredible right there. Uh, that means that AITX is definitely growing. They are growing as a company. Okay, cash only, that's the same thing. Let's go ahead and look at cash in short-term investments divided by total assets. Uh, so that is growing as well. Okay, that is growing as well. Which is basically let's see here, cash in short-term assets. So short-term investments, it's looking good. It's looking good. It's definitely growing. I don't see why they should have a big short-term investment position. Uh, but it's definitely good. It's definitely good. Okay, let's go to accounts receivable net. So basically, what accounts receivables, if you don't know what it is the total amount owed by customers in which the company is confident of collection. Okay, so this is receivables that the company assumes they're going to collect for sure. If you don't know what account receivables net is. So basically, the way this works is the higher the net receivables, the more confident of collection. And as you see here, it's been going up. So there's obviously more confidence in for collection. Okay. And the way you calculate this as well, if you want to make notes, I'm going to be going over how you find some of these factors of the income of the balance sheet. So if you want to make notes, go ahead and do that. So to find accounts receivables net, what you do is you take the total money owed to the company by customers minus the debt, and that is how you get the accounts receivable net. Excuse me. So accounts receivables gross is the same thing, and basically accounts receivables gross is amount of sales that a business has basically on credit and no payment has been received. That's basically what gross is. And as you can see here, it's the same amount. So I'm not sure what is going on there. Okay. It's just, that looks suspicious in a way. But anyways, it's growing, and their account receivables are growing, which is good. I'm sure they're not doing anything shady there, but it's growing, and it's looking okay. It's looking great. Definitely want that growing. So let's look here. Accounts receivable turnover. So basically, what this number, the higher, the better. It's also called the efficiency ratio. And the way you calculate this is you take the net credit sales divided by the average accounts receivables. And what this does is it measures how quickly accounts receivables is converted into cash, which is really, really important. And it's, within an accounting period, obviously. You definitely don't want, accounts receivables taking too long, and leaving the company without cash for research and development or different, day-to-day expenses that boost efficiency in the business. Okay, with that said, raw materials, let's see here, raw materials 316,000 in 2018. That's been going down, But obviously they have been producing very good products, so not too concerned on that. And then other current assets. These are assets that are not common. Example: cash, uh, trade receivables, excuse me, and cash equivalents. So 150, 83,000, and 32 as it goes, ending in 2019. That's it's okay. Not very important. Uh, it is important, but uh, not too important. Okay, so property, plant, and equipment gross. Here we're here. I have a paper copy, so I'm definitely, yes, we're here. So property, plant, and equipment gross has been growing, which is great. Okay, these are very important assets that a company definitely needs to show on a balance sheet. That they keep getting stronger. Property, plant, and equipment. Okay, very important to the balance sheet. Especially to investors, because this money is a safe allocation. Okay, basically, the assets are going up in value most of the time. Unless there's some type of crash or anything of that nature. Computer software and equipment. Okay, also very important for a technological company. For a technology company, that's what they do. So you can see that it's been going up. Okay, I mean, it's been going up okay. Nothing amazing, but consistency is key. Consistency is key. Other property, plant, and equipment uh, been going up as well. Very nice. That is very nice. Okay. Accumulated depreciation. Accumulated depreciation. Okay, the way you calculate this is cost of assets minus salvage value divided by life of the asset times number of years. Very long formula, but as you analyze balance sheets, it becomes pretty easy. And what this is the cumulative depreciation of an asset up to a single point in life. Okay, so depreciation of an asset up to a single point in life. So if you don't know what depreciation is it goes down in value. That's what it is. Okay, intangible assets. Let's see where we at in the screen here. Intangible assets. Huh. There. 56,000. So intangible assets, if you don't know what it is, it's an asset not physical in nature. Basically, things like brand recognition, intellectual property, things such as goodwill, what is it called? Rights, stuff like that. So 56,000, and it was reported in, a year very far away. So I'm not sure what is going on there. No new intangible assets. So other assets, minor assets. These are minor assets that don't fit the main asset category. So 30,000, and this year, which is a year far away, and now presently 3,000. So it's okay. It's nothing really important to look at there. But this is the main thing. So total assets. Total assets. Look at that. From let's see, what year is this? 2017. From 2017 to 2021. Let's see, 2021. Yes, 2021. I mean, it's been growing ridiculously. Okay, this is incredible right here, which is good. You want the company to have assets. You want the company to have assets. Without assets, there's no growth. Okay, assets is the foundation to growth. Okay, as you can see here, they did slide down a little bit, which is normal. Okay, these companies are they are going to slide down. They are going to come down in assets because they had to sell assets. They had to, uh, for basically research and development, day-to-day operations and stuff like that. It's going to happen. Uh, it's natural for these companies to go up and down. What's really natural for a lot of companies to go up and down in assets. Uh, but depending on what sector and the stage of growth and that type of stuff. But for this company, it is very normal. Okay, so now liabilities and shareholders equity. So short-term debt and current portion, long-term debt, it's definitely gone up, but then came down from the year 2020, obviously with the pandemic, 8.66 million, and then came down to 2.13 million. So that's very, very good. They did pay down that liability big time. So if you don't know what short-term debt and current portion long-term debt is the amount of principal and interest of total debt that is due to be paid within 1 year of time. Okay, so that's why it's called short-term debt and current portion of long-term debt. So this is the total short-term debt and long-term debt. Okay, so for short-term debt though, because the previous one was both short-term and long-term, but for short-term debt, which is debt that must be paid within 1 year. Okay, it has gone up, but it's normal. It goes up and down. It goes up and down. It's completely normal. It's nothing out of hand. They look like a pretty well off company that does pay their debt. Nothing to really worry about there. It has been increasing, but obviously assets have been increasing as well. So, that's good. It's a very, very good thing. You need debt to grow. Okay, so current portion of long-term debt. Long-term debt is obviously debt that could be paid in more than a year, more than a year's time. So it has also gone up, but it has gone down as well. Obviously 2020, 7.35 million, and then it came back down in 2021 big time. So like I said, this company does pay their debt, and it's a trustworthy company in terms of paying off liabilities. Accounts payable has grown. Okay, this is money owed to supplies, money owed to to vendors, excuse me, for supplies. So from 2017, 12,000 to 2021, 1.35 million, which is good because that means that they're needing more supplies. They're building more products, putting together more products. Great. This is definitely what you want to see in a company that's at this stage. Okay, so miscellaneous current liabilities. If you don't know what this is an account for current liabilities that do not fall in any previous categories of accounts. Examples of miscellaneous current liabilities include accounts payable, account accrued expenses, and short-term notes payable. Okay. Let's see. Miscellaneous current liabilities has gone up. It's okay. I mean, it's definitely something that you want to see go up, but not too much. And they did a very, very good job. Uh, Obviously, 9.87 million in the year 2020, but then they paid that back, and it came back down to 908.81 thousand. Very, very good job. Fantastic. If you want the formula for this, this is notes payable plus accounts payable plus accrued expenses uh, plus unearned revenue plus current portion of long-term debt plus other short-term debt. So it's basically a bunch of addition of all the those types of uh, liabilities. So total current liabilities, the sum of accounts payable plus accrued liabilities plus taxes. Okay, it has gone up, but then also it came back down. They peaked in 2020, but obviously that is normal. Okay, it came back down in 2021. They paid it off. Great. Long-term debt, debt that matures in more than 1 year. Obviously, as I stated previously, uh, this is uh, this is something that should worry people, but uh, obviously 8.87 million. You could look at the miscellaneous current liabilities at 9.87 million, and it was paid off. So long-term debt 8.87 million. Uh, I am concerned a little bit with the interest and all that stuff. If they let it get too out of control, but I'm pretty sure this company can pay that off without a problem. Okay, obviously as revenue increases with the new products, and obviously Steve, he just hired a VP for sales recently. Everything's going to be turning around. In terms of sales, they're going to go through the roof. So this is completely normal, and it should be payable and without a problem. Okay, other liabilities. Obviously, other liabilities. 55. Went from 55,000. Let's see, where am I at? 55,000, 55,000.92 to $2.83 million. They let that account go a little bit out of control, especially presently this year. But I'm sure it's payable. It's payable. It shouldn't be that big of a problem. And obviously total liabilities. So it went from $506,000, okay, to 16 million, and it peaked the second year, which was 2018. Here, 35 million. So obviously, look, this company can pay off debt without a doubt. Okay, this company is reliable, it's trustworthy, and it's okay. They need money. They need money. So don't worry about it if next quarter or they come out with some ridiculous liabilities. The company is definitely trustworthy, and you can trust the company will pay that debt back. Let's see here. If you want to know what the total liabilities slash total assets is, it's basically the proportion of the company's assets which are financed through debt. Okay, so you don't want a company that has that is basically financed with debt, because the investors and the inside shareholders have less to lose. You want a company that has a lot of assets financed by equity, by shareholder equity. Okay, because like that, investors have more to lose. People that own the company have more to lose, and the company is, basically there's more motivation for the company to do well when, say, for example, you have $500,000 in the company as a shareholder. Okay, you're going to be putting pressure on the CEO, and the CEO is going to be, under pressure to get that company uh, to basically profitability. Okay, almost done. And then at the end, I'll just go over and uh, see what I think about it. So let's see here. Where are we at? Preferred stock carrying value. Uh, if you don't know what that means, it's just stated value of an ownership interest entitled to fixed dividends and privileges than common stock. So it's basically stock that has a little bit more privilege uh, than your normal uh, stock that you can trade. That me and you or little investors or retail investors or whatever can trade. Little investors in terms of their eyes. Okay, if you're not an accredited investor with more than $1 million or have recently earned more than $200,000 in the last 2 years, as stated in the FINRA laws and regulations, then you're not an accredited investor. Okay, so don't really have to worry about that. It looks okay. It looks steady. It's been steady. Nothing too much to worry about there with preferred stock. Let's see. Common equity total. Excuse me. Non-redeemable preferred. No. Blah. Common equity total. So this is the. If you don't know what common equity total is, the total investment made by common equity investors, which is basically investors that are not investors like me and you. Investors like me and you. This has gone up, but it also has gone down in the recent year 2021, in present year 2021. So it's a little bit concerning there, and it did come down a big amount. But I think this has to do with the dilution. Okay, people are concerned about dilution. Okay, but that's pretty much it. Whoops, never mind. Yeah. Ow. Had my shoulder pop there. No, wait. I have a little bit more to go. Let's see. Excuse me. Total shareholders equity. No, that's the same thing here, down there. Has gone down, like I said. Total equity. Where's it at? Total equity. Did it go over that? No. So if you don't know what total equity is the basically the amount invested by investors in exchange for common stock. Obviously, if you don't know that, you should. But yeah, to summarize this balance sheet here, like I said, it's a obviously the total assets equal to total liabilities. Yes. Gotta always make sure that the here the total liabilities equal the total assets 1.57 million and 1.57 million in terms of liabilities. That's why it's called a balance sheet. If you didn't know why it was called a balance sheet, because the total liabilities equal the total assets. There's many ways you can word it, but that's the way I'm gonna word it. But analyzing this income statement, this balance sheet. I don't know why I keep calling it income statement. I think this company is definitely doing good. Like I said, their assets are growing. uh, property. What was it called again? What is it called? Property, plant, and equipment is definitely looking good. Uh, Short term, the debts, like I said, they're payable. Everything is looking good. Everything is great. Okay, everything is great. I understand the shareholders' equity has gone down, but that has to do a lot with dilution. But like I said, this is a long-term hold. Okay, don't go in and put in like, um, let's say 15, 20% of your portfolio into this company. Okay, that's not what you do here. You put in like less than 1%. Okay, uh, so let's see the stock. Let's see the chart. Let's go over a little bit here. So this is why people are concerned. Uh, this is why shareholders' equity has gone down. Check this out. So here, you see that? You see that? Dip, dip, most likely dip. Now this stock did go up to 25 cents here, 26 cents actually, from 0.0042. So it's probably up for a little short squeeze here, but I would say go in long-term position, go in here, 0.026, 26 or 26.2. Yeah, go ahead and if you want to do a little long-term position, if you go over the company, if you like what they do, if you like, uh, basically their mission, if you're about it, if you believe in it, I would say wait here, wait for this price around here, or yeah, definitely wait for this price around here. Go ahead and put a long-term position there, and then just dollar cost average it as it comes down. Um, I do think most likely it will come down. Uh, let's see. I'm not sure this company will come back down this low because it's obviously been growing recently. So yeah, go ahead and if you want to get in now because most likely this company will, and they are looking uh, for other companies, like basically an acquisition is what it's called. So they're looking to buy other companies as well. So once that news comes out, and you know uh, that they bought another company, and most likely they've been working a lot with Ghost Robotics, so I'm not sure what is going on there. And Ghost Robotics is definitely a company to look at as they work with the military, and they have government contracts and uh, that type of stuff with the military in terms of military robots and whatever they have going on there with uh, defense robots and all that type of stuff. So if they were to buy Ghost Robotics, that would be amazing. Okay, this stock would probably go up to $1, in my opinion. Okay, even though it's very very diluted, that would be very very great news for this stock. But expect this company, excuse me, to grow. Basically, to summarize it, expect this company to grow. This company is uh, like I said, trade it over the counter if you want to go ahead and start a position in it. And like I said, don't uh, buy too much. Okay, don't risk a lot in a company like this. Obviously, I believe in the company long term. Okay, 5 to 10 years. Okay, this is not a buy now get rich tomorrow type of investment. Just because you can buy a lot of shares doesn't mean it's going to make you money. Either short term or long term. Okay, so invest, with the brain, not with uh, your gut. Okay, sorry about all the. I just kind of sick at the moment, but yeah, basically get in now. This company will reach $1 in the next 2 to 3 years, in my opinion, maybe even 5. Okay, maybe even 5. So, in long term, like 10 years, I do see this company at 20. I do think as this company becomes more profitable, the company will issue, excuse me, will buy back shares and decrease the amount of shares available in the market, basically raising the stock price. So that's a lot of uh, basically what these companies do as they grow. Right now they are diluting, and once once that growth definitely hits the company, the opposite is going to happen. People want profits. Okay, people inside the company want profits. Investors want profits. Okay, don't think that this company is a stupid company, where the people working at this place are dumb, because they're not. Right now, they might not be getting great returns in their stock or in their holdings of this stock, but believe me, this company, once the products hit the market solid, in a solid manner, and sales are you know hit basically hit hard, in terms of not hit hard, but uh, sales are boosted. In other words, the stock will definitely go through the roof, and I'm sure the CEO will buy back the shares, and the company will buy back the shares, excuse me, as a whole. Uh, these people want money. Everybody wants money, and this company, like I said, it's traded over the counter, but it has been in business for some years now. So this company most likely will not go bankrupt. It didn't make it through the 2020 pandemic, so that shows you that this company is pretty strong. Obviously, the stock is coming down, but it the why it is coming down is because it's growing. Okay, they are diluting the stock to get more money to grow. Okay, so with that said, that's pretty much about it. That's going to summarize the video. Go ahead and I recommend looking at the manifesto, looking at what they do. They also have a YouTube channel. Uh, it's called AITX. Uh, very, very great YouTube channel. The CEO always comes out with updates, weekly updates, and all that good stuff. Especially if you're invested, you definitely want to, be up to date with everything that they're doing, and what your money is basically doing. Okay. So with that said, thank you very much for watching the video. This is a pretty long video. This video is not for a lot of people. Definitely going over a balance sheet is pretty boring. But if you want to be successful and basically invest in companies that are undervalued, or have very, very great amount of potential in terms of growth, you have to do this type of stuff. Okay, you have to do this type of stuff. If you don't want to do this, if you don't want to waste your time doing this, go ahead and look up YouTube videos, or if not, just invest in a regular ETF, S&P 500, or basically a technology sector ETF, or there's now artificial intelligence and robotics ETFs. I believe Standard & Poor has one, and there's I believe also Global X has one. So with that said, thank you very much for watching. Go ahead and subscribe if you did like the video, and also like the video if you liked the video. And if you didn't, we'll go ahead and dislike it. But anyways, thank you very much. Greatly appreciate it. And you guys have a great night, great day, wherever you're at. Thank you.